Hello everyone, this is Paris. Welcome to Budgetholics. In today's video we're going to talk about how to invest when every asset is inflated. Stocks are extremely expensive, crypto is at an all-time high, and depending on where you live, real estate prices are off the roof. The first thing we need to do is understand why assets are so expensive, how to determine if an asset is expensive or not, and what we can do about it. And without further ado, let's jump into answering these questions. Let's start with the stock market and the S&P 500. The S&P 500 is an index that tracks the performance of the 500 largest US companies. You can think of it as a basket containing those 500 largest companies in the US stock market. But what do we mean when we say the S&P 500 is trading at an all-time high? What does this mean and how does stock price relate to real value? A good thing to look at when evaluating either an index or the stock of a company is the PE ratio. The PE ratio is a financial metric that is defined as the price of the stock over the earnings per share. And the earnings per share refer to the earnings of a company divided by all available shares. So let's assume that you had a company that made $1,000 in a year and the total value of all shares available is $1,000. That would mean that this company is trading at a PE ratio of 1. However, this company is very likely to have revenue in the future. So nobody is selling at a PE ratio of 1. Therefore, due to the laws of supply and demand, companies are usually traded above a PE ratio of 1. This metric is usually looked at by long-term investors who are looking to buy a company now and hold it for the long run. Returning to the S&P 500, which is an index comprised of different companies and the weight of each company in the index is relative to the company's size, the S&P 500 is currently trading at a PE ratio of 40. This means that for the average company in the S&P 500, investors are willing to buy $1 of current earnings for $40. Now, no single ratio and no group of ratios are going to paint a complete picture about how a company does. But regarding the S&P 500, it gives you a general idea what investors believe about companies' future earning potentials. But even when looking at the PE ratio within the S&P 500, you can find huge discrepancies. For example, Apple is currently trading at a PE ratio of 39. In contrast, Tesla has a PE ratio of 1700. This means that investors believe that Tesla has 40 times the revenue potential of Apple. In order to gain a complete understanding of a company, you need to look into the company itself, in the sector it operates, and evaluate the degree to which it has a competitive advantage over other competitors in the same industry. Another thing that points towards the huge disconnect of the stock market and the real economy is the Buffett Indicator. The Buffett Indicator compares the total value of all stocks in the US market versus the US gross domestic product. And you can think of the US gross domestic product as the total earnings of the US economy. You can look up those graphs yourselves in a site called Current Market Valuation, for which I'll leave a link down in the description, but let's focus on two graphs. The first one shows that the Buffett Indicator is increasing. As you can see in the historical trend line, in the 1950s the Buffett Indicator was at around 50%, which means that the total market value of US companies amounted to 50% of the GDP, and by 2020 the market value to GDP ratio was expected to be around 120%. This means that a fairly priced stock market without being overvalued or undervalued would amount to 120% of US GDP. But the current stock market value is more than double the GDP of the United States. And every time this has happened, it is an indication of inflated asset prices, also known as a bubble, which then burst, leading to a huge market crash. And as you can see in this graph, since the 1990s we had two huge market crashes. The first thing to look at is the dot-com bubble starting off at the early 1990s. You can see that at its peak, the US stock market had a value 71% larger than the GDP of the United States. And we all know that this bubble burst and the market collapsed. Another instance to look at is the financial housing crisis of 2007, which led to the US stock market being valued at only 50% of total GDP. In January 7th, the stock market was valued at 180% of the country's GDP. And when the stock market falls into that overvalued range, this is a usual indicator of a coming collapse. This doesn't necessarily mean that a crash will come overnight or that the real economy will collapse itself. It just means that at some point the stock market will have to come to terms with reality and converge with the real economy. Moving on to cryptocurrencies, Bitcoin also reached an all-time high of $40,000 in January. Keep in mind that the previous all-time high was in 2017 at $20,000 before eventually crashing to $3,000 in 2018. Bitcoin seems to have undergone some sort of correction as it reached $31,000, but now it's also up again at $35,000. The problem with Bitcoin and cryptocurrencies in general is that there are no solid ratios to rely upon and base your arguments. Thus, the main driver of Bitcoin price is faith. Faith in either the Bitcoin technology or the ability of the asset to make profits for investors. The people who believe in the Bitcoin technology are not likely to buy and sell depending on what the stock price does. However, since most Bitcoin appears to be held by investors right now, volatility in the Bitcoin to USD exchange rate is expected. Investors will always try to buy low and sell high, and in the presence of a slight indication of corrections, investors are likely to start panic selling to lock in their profits. The same happens when the price of Bitcoin is increasing. People will experience a fear of missing out, causing them to start buying in a purely speculative manner. And the same holds for the stock market. In terms of what to do now, you have three options. And before doing any of these, you need to smash this like button and subscribe to this channel. Returns guaranteed. As I've said time and time again, it's always to have a healthy stash of investment cash on the side. This will allow you to invest in a good opportunity that might arise, such as an IPO or a local business. But this stash of cash is also very useful during financial downturns. Now, this cash is separate from your emergency fund, which is only for times of emergency. Instead, it's other money you have on the side for good deals. When you can't find good places to put your money in, this is a good indication of an imminent stock market crash. And as an investor, you should never fear a coming stock market crash. You need to remember that asset prices are all a matter of psychology. When stocks go up, everybody is talking about them, everybody in the media is talking about how the stock market is at a new all-time high, and everybody is experiencing a fear of missing out. This in turn causes people to start panic buying, thus driving the prices of all assets upward. And especially today, with more retail investors having access to easy-to-use trading apps with low or no fees, this effect is amplified even more. The opposite happens when the stock market is crashing or when Bitcoin is dropping in price. Everybody is panic selling, trying to lock into their past profits, thus contributing to the further drop in asset prices. You should never be afraid of a stock market crash. The stock market crashing is like Black Friday for stocks. It's the best time to buy great companies at a discount. And this is indeed what happens in a stock market crash, in a recession, or in a bear market. Companies go on sale. And how do you prepare for a stock market crash? It's the same with Black Friday. You keep the money on the side to be ready to buy this great 4K TV at a low price. There's no point in going to a sale if you don't have the money to buy the things you need or the things you want. And that always strikes me. How are people increasing their credit card debt in Black Friday or Cyber Monday when they know a year ahead that this event is going to take place? Do not max out your credit cards either for Black Friday or stock market crashes. Instead, plan for them. If you want to learn how to manage your money properly, check out this video for which I leave a link here and down in the description. Don't go into debt in order to invest. Your credit card has a guaranteed 20% rate of loss for you. Instead, use your investment cash and only buy what you can afford, both in terms of assets as well as in terms of Black Friday deals. Also, never tap into your emergency fund to buy things at a discount. This holds for stocks, this holds for iPhones. Budgeting principles remain constant regardless of what you buy. When it comes to investing, the equivalent of credit cards are margin accounts that allow you to trade more than what you actually have. Avoid using those. There are various ways to store that emergency investment cash. You can either have it in a high interest rate savings account or you can have it in a money market account. However, it always needs to be liquid, similar to your emergency fund. Keep in mind, I'm not a financial advisor and this channel is for entertainment purposes only. Always do your own research and never rely on a random guy on YouTube. If you need help, consult a certified professional. When it comes to investing in any asset, you need to be buying great companies or great cryptocurrencies or great real estate at a good price. Your goal has to be to buy this wonderful business at a discount and hold on for dear life as the market rises. That's how you achieve a consistent great rate of return. When the market's at a peak and all the assets you're looking into are extremely overvalued, don't buy. And those assets that you think have gone way over their real value, sell them. That's what the greatest of all time does, and that's what you should do. Be fearful when others are greedy, and be greedy when others are fearful. Or in the words of Henry Ibsen, the majority is always wrong. That being said, also beware of capital gains tax. Sometimes it might not make sense to sell an asset before holding it for at least over a year. Again, consult with a certified accountant near you to give you the best advice regarding on the assets you invest and how you can buy and sell them. Now, while asset prices are rising and you cannot find anything to buy at a fair value within your watch list, maybe it's time to expand your watch list. And this is one of the things I'm doing in 2021. You can watch a video regarding my strategy for 2021 using the link I leave here and down in the description. When assets are overpriced, maybe it's time to expand your watch list. You can research other companies, or you can expand your watch list to include assets from other asset classes, for example cryptocurrency. But first, you always need to research what you're investing in. If cryptocurrency is also overvalued, look into ways to invest in real estate. As I've said time and time again, expanding your circle of competence is always a good thing, as long as you do it diligently and not only scratching on the surface. And if you expanded your watch list and you still can't find anything of value to invest in, you have two options. Either hold the cash and wait for something to come up, or invest in yourself. In the words of Warren Buffett, generally speaking, investing in yourself is the best thing you can do. Anything that improves your own talents, nobody can tax it or take it away from you. They can run up huge deficits and the dollar can become worth far less. You can have all kinds of things happen. But if you've got talent yourself and you've maximized your talent, you've got a tremendous asset that can return tenfold. Now, when asset prices are high, do you really need to invest this $100 into Tesla stock? Or could you maybe invest in yourself by buying a course on Coursera on digital marketing or coding and then sell these skills to others? You can then take that skill and turn it into a side hustle. For example, you can start designing websites. And after a while, after you've established some reputation, you can take this side hustle and turn it into a business. Not all of these skills are going to be valued equally by the market. However, investing in yourself, either in terms of education or investing in your health by adopting a better diet or by exercising, has always had positive returns. You are the one asset you cannot lose of, and you are the one asset of which you have total control. These are my thoughts of how to invest when asset prices are high. Also, let me know down in the comments below what are your thoughts on the stock market crash of 2021. What are your thoughts of investing now when the asset prices are extremely high? And let me know what do you think are the best assets to look into, either now or after a stock market crash. Also, if you enjoyed this video, please like it and hit the subscribe button, as this helps me immensely with the YouTube algorithm. Finally, if you have some crypto on the side and you want to earn interest on that crypto, check out BlockFi, for which I leave a link down in the description, as you can earn 8.6% interest on your deposits, plus up to $250 if you deposit $25 or more. Until we meet again, don't stop investing, and in the words of Jack Bogle, good luck investing in those interesting times. Cheers!